let's get to this. So for chapter 6, you have the discussion for chapter 6. We have some video solutions, so definitely watch that. We have 2 homework looks like and 1 quiz. For chapter 7, we will have a discussion again, video problems, which watch that. And after you study and watch those videos, try to do 2 homework and again, 1 quiz. So for chapter 6, let's go ahead and talk about cash and liquidity investment. We will look at composition of cash in the balance sheet. We will look at cash management. We will look at the very important subject in accounting, and any business owner, anyone that wants to run a business to understand the bank reconciliation. And also we will look at the petty cash. All of them are important. So let's go one by one. Okay. So cash is like actual cash in your bank. It is free. It's available to you. You can pay the current liabilities, includes saving account, checking account, currencies, coins. Technically, if you see cash in the balance sheet, it says cash, that includes petty cash also, and any kind of checking account or saving account, including coins and bottom line, all cash in the business. Combined, you can see in the balance sheet that says cash. Of course, every cash has a sub account. That means you have checking account, Bank of America, checking account, Chase, saving account, Bank of America, let's say you have petty cash. Those are all cash, yes, but combined under main account of cash that will be reported in the balance sheet. Compensating balances, it says an amount that must be left on deposit and cannot be withdrawn. I have something like that. I have a checking in Federal Credit Union and saving. So both of them needs to have at least $5 so-called compensating balances at any time. What are cash equivalents? You will see in the balance sheet says cash and cash equivalents in one line. That's short-term interest earning financial instruments that are deemed to be highly secure and will convert back into cash within the next 90 days. So those are cash equivalents. So those short-term interest earning investments with the 90 days maturity, it will be considered as cash equivalent. So you see, like in this balance sheet, you see cash and cash equivalents and says, let's say 15 million. Now you know where that 15 million is coming from. If there's no question, I will move on to the next page. So cash budget, it's an important subject for a business. They have to have a budget at the annual basis, quarterly basis, monthly basis, at least for the next 12 months. And one of those master budget component is cash budget, which is an essential budget component detailing planned cash receipts, disbursements, and financing actions. That means in the cash budget says how much cash you're gonna receive from your sales, estimated, how much cash you need to disperse for your expenses, again, estimated, and do you have enough cash left at the end, which can satisfy the minimum requirement of the company. And the minimum requirement of a company can be $10,000, can be $5,000, can be $10 million, depends what and how big the company is. If the minimum requirement cash at the end of the budget is not satisfied, then they need to show how much financing they need to do in that period of time, let's say in that quarter, so the company doesn't get like last minute notice that we need cash. So because of having a master budget and obviously cash budget inside the master budget, the company knows ahead of time that probably, let's say in second quarter, we need to have, let's say $50,000 line of credit available to satisfy the minimum requirement, let's say, so we can survive during the second quarter and move on to the third quarter. For example, second quarter is a slow sales season. Okay, so that's fine. There are, in order to provide capital for a company, there is technically two ways to raise capital. Either you do equity financing, which is meaning you are issuing stock, or you are doing debt financing, which is borrowing additional funds to provide that enough cash so the business can go forward and do the daily business operation. There are some other, it says internal solutions also, which you can read here. Like you can kind of provide, let's say, sales, you can provide discount like net 210 net 30, let's say, by providing that option of paying invoices for 210 net 30. That means customers, if they pay in 10 days, they will get 2% discount on the invoice. That will accelerate the cash collection. In some cases, they postpone the cash outflows. Like some companies, they have receivables, but they cannot collect it, and then they call the accounts payable department, say, hey, why you are not paying? You have invoice open for almost 90 days now, and you are a big company, why you are not paying? And they typically, those companies are postponing cash flows, even though they have money, but they are postponing cash outflows because they want to hold a little bit more cash to satisfy the cash budget requirement. And cash control, obviously, it's a good idea. Internally, you can, have more control on your cash and to make sure there is no funny business going on and there's no employee theft or anything else in between. So you can read that cash control possibilities here. We can move on to the next page. Again, at any time, if you have any question, please don't be shy. Just ask, okay? Ask your questions. That's why I'm here. Otherwise, everything is here properly written. So here we go, bank reconciliation. It's an important control procedure to establish a verifying to verify the activities in the business on a monthly basis. So you have to do bank reconciliation every month. It is one of the best control you can establish in your company. You can find errors, mistakes, theft, anything. And if anything is necessary to be recognized or to be, investigated, there you go. Bank reconciliation is your best tool. That means every company gets a bank statement at the end of the month, and you need to reconcile your bank statement with your check T account. So here is your bank statement, says you have, let's say, $50,739. And then you look in your cash T account, and your cash T account says, no, you have $47,535. Totally different numbers. They are not even close. So that means there are so many things in here that you don't know, or there are so many things in the ledger that bank doesn't know. So you have to clarify that everything is under control and nothing is missed. And that's very important. So one of the things that might happen is deposit in transit. Deposit in transit, it's receipts entered on company records, but not yet posted by the bank. It means at the end of the month, let's say, I don't know, end of the month, let's say July 31st, you take a deposit, you do the journal entry and take the deposit to your bank, and you deposit in ATM machine outside your bank after 5 p.m. So the bank takes your check, deposit, that's fine, but it's not going to get updated into system. However, from your point of view, you already deposited, you already recorded in your accounting software in QuickBooks, and when you get the bank statement, all of a sudden you are looking for the last day deposit and is not showing there, because by the time the bank system gets updated through that ATM machine for your deposit, it will be the next day, and the next day is August, and August statement, you have to wait another month to get that. So that's why we call that a deposit in transit. That means your company deposit a check, but the bank statement is not showing such a transaction. Outstanding checks means checks entered on company records, but not yet cleared by the bank. Which means, let's say in the last maybe 10 days of, let's say in your month of July, you wrote few checks to pay few bills, and then you get the bank statement for month of July. You look at those checks that you wrote already and you recorded in your cash account, but you don't see maybe one or two of those checks cleared yet. That means the bank has absolutely no idea you wrote such a check. Your book is fine, but the bank doesn't know because it didn't go through the system yet. It's not cleared yet. So we call them outstanding checks. So deposit in transit, that means a deposit that bank doesn't recognize yet in the calculation of new balance. Therefore, you need to add that deposit in transit to the new balance. However, outstanding checks are checks that you already deducted from your book to get $47,000 here, but has not been deducted from the bank new balance of $50,000 here. Those outstanding checks needs to be deducted from the bank statement balance. So deposit in transit will be added, deposit add. Remember, deposit add, and check will be deducted. Outstanding checks will be deducted from the balance. NSF check, it's a bad news, and that's why you call it non-sufficient fund, because someone gave you a check to, paying an invoice. You were so happy and excited, so you record the check, cash received, debit cash, credit accounts receivable, and then you took the check to the bank, you deposit the check, and the bank shows the deposit. But maybe about 4 days later or 5 days later, the bank sends you a letter, says, hey, something went wrong. This check came back, bounced back, and it's an NSF check. So you see the NSF check in the bank statement. It has been already deducted from the bank balance. Also, sometimes it has a penalty on that has been also deducted. So that NSF check, it's a bad news for you, and you need to take it out of your cash balance, and that means credit cash and debit accounts receivable for the person who gave you the bad check. So the accounts receivable goes up again. Any question up to this point, please? No. Okay. So this is the way you do it. You take a let's say Excel sheet or worksheet or a paper, and you write bank balance. Then on the right side, write book balance, and then you say add, deduct, and then you end up by adding something to the bank statement, deducting something from the bank statement, which is here said deposit in transit is added, outstanding checks is deducted. And in your book, if there is any interest income from your checking account, saving account, you need to add that to that account. So if you have interest earning on your checking, here you show interest earned by adding. If there is NSF check, you deduct it from the book balance. You deduct the penalties. You deduct interest expense, if there is any interest expense in your bank statement. Anything that is deducted from your account, so you have to deduct it, like NSF check, for example. Bottom line, the balance at the bottom should be equal. That way, you know that everything is accounted for. Now, whatever is on your book needs to be journalized. So you have to journalize this, and you journalize the deductions. There's nothing to journalize on the bank statement. Bank statement, you just add, deduct to get the final balance. But anything in your book needs to be updated, so it needs adjusting it. So here it gives you an example with some details. So you can go through that later on. And here is the bank statement. It says in your bank statement, you have $50,000 balance. There is a few adjustments: service charge minus $50, $55, interest earning plus $119. Let's say deposits, total withdrawals, and the beginning balance. And in the QuickBooks, you enter the beginning balance, and you also update your service charge and interest earnings in the system. And then you look at these debits, deposits, and withdrawals, and you put a check mark next to it. So every account here, you see like check number 5454 has been already cleared. So you put a check mark next to it. And in the QuickBooks, in the box next to 445609, click that box, a check mark will show over there. You go to the next check, and you see the same amount is in the QuickBooks also. So you, with a pencil, you put a check mark here, and you click the box next to 245 in the QuickBooks, so there is a check mark next to it. So as you see, you put check marks as you go down in the bank statement. But in some bank statements, you might see a star. Not all of them, but some of them. This is a favor to you. When you see the star, that means it is telling you that there is a broken number in the check number. So here you see 5455 and 5456. It's not cleared yet. So that's why you have a star here showing a broken number. Again, here is 5461, yes, but 5462 is missing. That's why there is a check star here telling you that. So those are things that has been so-called debited from your account, deducted from your account, including all those checks and some other debit memos. They call this debit memo, like electronic fund transfer, NSF check withdrawal deduction, NSF penalty fees, and monthly service fees. But we have also some credit memos. Those are credit that the bank gave you, like $12,994.36 deposit, another deposit here, collection of a note receivable that banks, based on the agreement between you and bank is collecting this note receivable. And in the same time, part of this note receivable, you know that a portion of note receivable that the bank is collecting is technically the principal of the loan that someone borrowed from you, and the portion is the interest that you earned on that borrowing. So that's $5,450. And there is a credit card posting, which is $3,909.65. That's the credit card processing merchant service that you charge the credit card of your client, and that amount will be deposited into your bank, let's say in 48 hours or less. And also bank gave you another credit memo here is in regards to interest earning. So when the a dollar amount is deducted from your account, we call it debit memo. When an account is, when you see a balance is added to your bank balance, that is a credit memo. Do you know why we call it debit memo or credit memo? Did I talk about this before? Anyone knows why we call this debit memo and we call this one credit memo?
No.
No. Okay. So the good news is I will teach you. The bad news is no one will tell you or teach you this in future. Doesn't matter how many degrees you get, how many university you go, they're not going to teach you this. They're not going to talk about it. So this is just one-time event. So just learn it. It's a good idea. So let's put some T account here for you so you can see what I'm doing. And here, let's say, okay, so I have a T account here. I'm gonna make few. Okay, so imagine this is Bank of America. This is the Bank of America general ledger. So here is Bank of America and has a cash account, and Bank of America has a lot of money. Let's say here, $100,000. So Bank of America, right now in this branch, they have $100,000 cash. And then you enter the bank and you say, I want to open a business checking. And they will say, perfect, no problem. So here they open a checking for you. Checking 1, 2, 3, 4, 5, 6. That's your account number. And they ask you how much you want to put as a deposit to open the account. You say, I want to put, let's say, $5,000 as the initial deposit to open the business checking. So you give them $5,000 cash to open the business checking. They put the cash in the cash account, which is a debit, and then they credit your checking account for that initial deposit. This T account, it's a liability for the Bank of America. That means how much they owe you at this moment? $5,000, right? And then by, let's say, end of the month, they charge you a monthly fee, $25 monthly fee per agreement of checking account, business checking. So they're gonna take $25 from your checking account, and they call it service fee revenue. Let's say I try to be very clear. So it's a revenue for Bank of America, and that's equals to that $25. So far, so good. Okay. Now, also at the end of the month, Bank of America is a very generous bank, and they give you an interest on your deposit. So that's $2 earning of interest for your deposit. And that's a credit, obviously. And you need to debit something, which is that number. And that is interest expense for the bank. So now let's look at this. This $25 here, that's a debit. You see that? So when you get your bank statement and you see $25 monthly service fee has been deducted from your account, and they call it debit memo. Now you understand why they call it debit memo, because they debit your account, literally. That's why they call it debit memo. Because your account for them, from Bank of America point of view, it's a liability. Normal balance for any liability is a credit. So they debit liability, and that's why they call it debit memo. And they recognize revenue for that. But here, they credit your account for $2. And you see a credit memo in your bank statements says interest earned, credit memo, interest earned $2. And the reason they call it credit memo, because literally they credit your account. That's why they call it credit memo. So now you know, when someone says this is a debit memo in your bank statement, or this is a credit memo in your bank statement, you understand why it's debit, why it's credit from bank point of view. And that's why you call it also debit memo and credit memo. Any question on this? Okay, so here we have a credit memo, here, credit. We have a credit memo of $119 interest earned. And here we have a debit memo of, let's say, monthly fee of $30. So now you have to do bank reconciliation just like this. Okay. So you start with $50,000 on your bank statement, which is coming from here. And then you start for the $7,535, which is coming from there in your book balance as of end of the month. And this is your book, your T account. And you see all the so-called reference numbers, check dollar amounts, and day-to-day balances. And at the end, we have $47,000. So what you do, you say, okay, my bank says I have 50,000, but I have deposit in transit of $3,565.93. Where is that coming from? So if you look in your cash T account, right, from all the way to the top to bottom, you will see at the end of the month, you have a deposit of $3,565.93. However, when you go to deposit here, you don't see any deposit on July 31st for $3,500. So that is a deposit in transit because you did on the last day, probably in the ATM machine, and it was not updated. So you add that to your bank statement. But there are some checks that still, they are not cleared. Check number 5464, 5471, 73, and 74. Those are probably properly recorded in your book. But when you look in those checks, you see you have broken check in here, check missing in here, check missing there, check missing there. So those are check numbers that are missing, and you know how much they are because you have recorded them properly here. So those few checks that are missing will be deducted on this worksheet from your bank statement, and you get the final cash balance as $52,503.51. Then you do same thing on your book. You say, my book says I have 47,000. However, I see in the bank statement, there's 2 credit memos here. You see credit memo of $119, credit memo of $54.50. So those 2 credit memos are not in here in any shape or form. So I'm gonna add it manually in my worksheet. And then I deduct those debit memos. So credit memo, it's a good news. Debit memo for you is a bad news. So debit memo, bad news here, 10907. Electronic fund transfer for utilities, debit memo of NSF check, NSF penalty, and service charge. Those are all bad news debit memos. You deduct them from your book, and you get to final number of $52,503.51. Any question, please? Okay. The whatever you did in the book worksheet here on your company's book, add something, deduct something, needs to be journalized. Normally, I don't do the way your book is suggesting to do. I absolutely disagree with this. You can do it, but it is hard, it is misleading, and it is hard to trace and audit in future. So what I do is I do every single one of them one by one. The reason I like to do every single one of those adjustments one by one, very simple. Because all these things, as you see in here, you can easily see in your bank statement as separate independent number. So if you look at this journal entry that your book is doing. How much is it? $4,968.21. Can you see that 4,900 something in here? Do you? Absolutely not. So it's very hard to understand where is that $4,900 idea coming from. So you do one by one, okay? One by one, exactly the way your book bank statement is showing, and that will be the best option for you to do bank reconciliation in future for your business or accounting purposes. But here, this is the way your book is showing, and I can live with this, but I don't like it. So like this one, utility expense debit, right? Cash credit, I do that. I do 109 debit utility expense, cash credit 109, and that will match with this number. Piece of cake. And then NSF check 437.06. You see here is 437.06, let's say. So that 437.06, that is an NSF check. That's the credit memo. And you have to deduct from your cash. So you can easily do that. So you do debit accounts receivable for the client that gave you the bad check, and you credit cash. For NSF fee, again, same thing. You credit cash because it has been deducted from your account, and you debit either miscellaneous expense, or if you talk to that bad client that gave you a bad check, you add it to his accounts receivable. So debit accounts receivable, credit cash. Or if the customer is not going to pay, then debit miscellaneous expense, credit cash. For service charge, same thing. You debit bank service fee expense, or if you like miscellaneous expense, but I like bank service fee expense, debit and credit cash. So you do every one of them one by one. Now, also you have 5,450 collection that needs to be done also separately, because again, I like to match exactly with whatever is in the bank statement, so it can be easily traced in future. So what I do on that one, I will imagine a portion of this 450 is the interest. The interest income is 569, reflect that posted by bank, 119 plus 450 on the collection of note. Okay, so the collection of note 450 is interest. So the journal entry to record this will be debit. Let me use this 5,450 here. The journal entry on that will be debit interest income. let's say for 450, you not debit, credit. You got cash of 5,450. So that's a debit. That's a credit. So you debit 5,450 cash. You credit interest income for 450. The rest is reduction on the principal. And the principal, it is note receivable. So that's equals to that box minus that cell, enter, and that's 5,000. So this is the journal entry to record the interest collection and principal reduction and collection of $5,450. The note receivable, let's say it's $50,000. Every time you collect a note payment, a portion of the payment of note that you collect is reducing the principal, but a portion of note that you are collecting, it is interest income. Any question on this, please? And again, this $119.34, it's an again separate number as you see here, $119.34. That number needs to be also journalized separately as interest income. So that number will be another journal entry. You collect cash, let's say 119, I believe, and some change, and that's a debit, and you call it interest income, and that's $119, let's say. So that's the journal entry for that. So you separate all those journal entries. It is easier to recognize all individual lines in here one by one. And since you are recognizing them one by one, that will be also very easy in future to audit, go after it, verify it. But the way your book is doing, like it's complicated. Here shows interest income of $569.34, which you cannot find it anywhere. Cash of $4,968, you cannot find it anywhere. Yeah. Miscellaneous, this one you can, but not the other two numbers. So it's this one is hard. Any question? Okay. So you know what the debit card is? It's a transaction that is equivalent to electronically generated check. It's just like a check, but electronic check results in an almost immediate withdrawal of funds without charge, without like 3% charge or something. So that's why debit card, it's very like preferred in a business when you want to pay something. They say, oh, can you pay by debit card? Because there is no transaction fee. It's just like electronic check. Okay. Petty cash, again, it's very important for a business to establish a petty cash to make small payments that are impractical to pay by check, also known as impressed cash fund. but petty cash is the common. Impressed cash one is too fancy. Okay, so every business needs a petty cash account to pay for small expenses. You need to establish that petty cash fund. So you write a check, you go to bank, you cash the check, and you put that $1,000 or whatever in the safe box in the company. And then you use the cash to pay for small expenses, and you keep the receipts. Then, and this is the journal entry to establish the petty cash. Then at the end of the month, you need to replenish the whatever is missing from that $1,000 established petty cash. So the replenishment is based on adding up all your receipts. Let's say ends up to be $615 of receipts for different reasons. So you write a check again, this time at the end of the month, and you go to bank, you cash it, put it in the safe box, and keep the receipts in a record file. And now your safe deposit box has again $1,000. So your purpose is to get back to $1,000 every single month, and keep the records of receipts and recognize expenses. So let's say your receipts are $615 and you got 3 receipts. One of them is $390 supplies. You record it as supplies expense debit. One of them is $155 fuel. You record it as fuel expense debit. One of them is, let's say, postage or something. You call it miscellaneous in this example, and that's $70. And you credit cash and you write the check, go to the bank, cash it, put it in the safe deposit, and keep the receipts. If by any chance the cash is a little bit short and over, let's say for some reason there is something, a receipt that is lost, you don't know what happened to it, it's okay. So you can put that $20 into cash short and over. And in this case, because it's short, then you put it on the debit side. Cash, if it's on the debit side, it's just like an expense, right? If it's on the credit side, it means you are over. So in this case, it's a debit side, that's fine. If next time you are over, for some reason, you have more money than you're supposed to, then you credit cash short and over. But in this case, you are short $20, so you put that on the debit side of cash short and over. And you write a check to make sure that you get back to that $1,000 no matter what. In case in future you realize this $1,000 idea is not good and you need, let's say, $1,500, then you write a check, again, just like this. You write $500 check, let's say 3 years later, and then you do such a journal entry again for $500, and you increase the base of your petty cash from $1,000 to $1,500. Okay. Fair value accounting is called also mark to market. That means you record an investment at its fair value and recognize changes in value as they happened. So if you have an investment account, normally investment accounts, you do a fair valuation at the end of the year to make sure that that investment has not lost value. Okay, if it let's see, there's an example here. So here says the company was seeing a pickup in their business activity and believed that a similar uptick was occurring for these competitors as well. One of his competitors was a public company, and its stock trading at $10 per share was at $10 per share, but Webster had excess cash earning very low rates of interest and decided to invest in Miriam with intending of sell off the investment in the very near future for a quick profit. You see, this is a short-term investment. The following entry was needed to on March 2016, the day Webster brought stock to Miriam. So the short-term investment will be recorded for $50,000 investment in the stock, and cash will be paid to buy that 5,000 shares of these publicly traded companies. Next, assume that financial statements were being prepared on March 31st. Despite Webster's plan for quick profit, the stock declined to $9 per share by March 31st. Webster still believes in the future of the investment and is holding the 5,000 shares. He's not selling, but accounting rules requires that investment be written down to current value as a form of conservatism in accounting, with a responding charge against income. The charge against income is recorded in an account called Unrealized Loss on Investment. So you record that as a loss. You call it unrealized loss, but still it's a loss. And the reason you put it in the income statement, because this was a short-term investment, okay? And if you like to hold it for a little bit more, that's fine. But if there is any loss in value of your short-term investment, you have to be very conservative in accounting and you have to report that loss. So here you are writing down $5,000 of your short-term investment. For now, your short-term investment has just $45,000 showing in the balance, and you record a $5,000 unrealized loss on investment because of that event. And that goes in the income statement because this is a short-term transaction, short-term investment. Notice that loss is characterized as unrealized. This term is used to describe an event that is being recorded, so-called recognized, in the financial statement, even though the final cash consequence has not been yet determined. Hence the term unrealized. When you say unrealized, that means it's a loss, but still you don't have actual cash in the account, in the checking account yet. So you didn't sell them yet, but technically it's a loss. During April, let's say a month later, the stock of Miriam goes up by $30 all the way to become $12. At the end of April, another entry is needed if financial statements are again being prepared. So in this term, short-term investment will be again valued at fair value of $12 per share. That means your short-term investment went up by $15,000, and you record unrealized gain on investment. That's $15,000. That will be a credit. So this time your short-term investment went up. So your total short-term investment here was 50 minus 5 plus 15. So your short-term investment right now in the balance sheet shows $60,000. or here. So 50,000 minus 5 in March to become 45, and then plus 15 in April to become $60,000 in the balance sheet. Okay. So here is important. Let's read this. It says the fair value approach is in stark contrast to the historical cost principle. The rationale is that market value for short-term investment is readily determinable because it's a publicly traded company, so you can easily and conveniently determine what is the actual value of that account. And the periodic fluctuations have a definite economic impact that should be reported in your financial statements. Given the intent to dispose of investment in the near future, the belief is that change in the value likely have a corresponding effect on the unlimited cash flows of the company. As a result, the accounting rules recognize these changes as they happen, and you can see them on the income statement. Oh, when you do short-term investment, here says, sometimes you get a dividend on them, which is true, right? So whenever you have the dividend, now that dividend has to be recognized as income. So you record the $5,000 cash received from that investment at that moment, and you record the income. You call it dividend income, correct? 5,000. Okay. Any question on chapter 6?
I had a question about recording the changes in stock price for the short-term investments. I was wondering, since stock prices tend to fluctuate like every day, how often do businesses actually record the changes in the prices?
Depends
Is
how
it periodic?
often. Yeah, depends how often they prepare financial statements. If they have to prepare financial statements on a monthly basis, then they do recognize that fluctuation in monthly basis. If it's quarterly basis, then quarterly basis. If it's not annual basis, then you do an annual basis. But most publicly traded companies, they have to report quarterly basis anyway. So definitely, I think it's quarterly basis. Good question. Anything else? Let's see. Why is the account called cash shortened over? Does the over mean something? Yeah, because sometimes in your petty cash, you might, for some reason, have few cents or few dollars extra. Let's say the cashier made a mistake, gave you $1 extra, and you didn't notice it, and all of a sudden you have $1 extra in your petty cash. After adding your receipts, end up to be $1 extra. So that's why that account, cash short and over, will help you to put few dollars short, or sometimes $1 or $2 over in that account, just to record it and journalize your transaction. So that's why I call it short and over.